So why should you care about fertilizers and energy right now? Because both sectors are experiencing structural shifts that create multi-year tailwinds. For fertilizers, the Strait of Hormuz disruption is particularly ill-timed for U.S. agriculture. According to the CSIS analysis, the strait's closure came just ahead of the spring planting season, when fertilizer demand is highest. U.S. fertilizer markets have no strategic reserve, and domestic production cannot scale quickly enough to offset sudden import disruptions. This creates acute pricing power for domestic producers. The Texas Farm Bureau warned that without prioritizing delivery of critical inputs like urea, ammonia, and nitrogen, and phosphate, the U.S. risks crop shortfall, which is not just food security issue, but a national security concern. For energy, the thesis is even more straightforward. The EIA forecasts that U.S. liquid gas exports will rise 1.9 billion cubic feet per day in 2026 to average 17 billion cubic feet per day. Natural gas producers and utility companies with strong balance sheets are positioned to benefit from both domestic data center demand and rising liquid gas export capacity. Bottom line, these aren't glamorous sectors, but the fundamentals are undeniable. Fertilizer companies with domestic production capacity are seeing margin expansion during a critical supply crunch. Utilities and natural gas producers are entering a multi-year infrastructure build-out cycle driven by AI. While everyone else is chasing the next meme stock, smart money is positioning in the picks and shovels that make everything else possible.